Now, a tax resident in South Africa, you are legally required to declare your worldwide income, so foreign, local, from third country, anywhere. Declare all of that to SARS. And then you apply, be it exemptions or tax credits, rebates, whatever it is. A tax non-resident is only then liable for South African sourced income. Okay, and a lot of people think that just because they've left or they work abroad, they are the second category, the non-resident.
The expat tax, there's obviously when you're looking to potentially immigrate or moving between countries, you have potentially two options. As far as I see it, you have a financial immigration. It's kind of the final drawing the line, or potentially declaring once a year. You need to declare to SARS, working on specific days and specific during the year. So if you want to maybe just give us a breakdown between the two options that you can utilize.
Absolutely. So there's actually three options, maybe even four for expatriates. Luckily, our legislation is still good enough that it allows for, a bit of flexibility, but it's all very case dependent. So always get personalized advice. Never just assume the blanket approach. In South Africa, SARS kind of sees you almost guilty before proven innocent. So it's up to you to provide all the evidence and prove and declare and formalize anything and everything. Nothing is going to automatically happen for you, unfortunately. And we get a lot of that confusion through people assume I've left or I'm working abroad. I don't have to declare anything to SARS. I don't have anything local. It's fine. Unfortunately, that's not the case. So the options that exist is that differentiates between being a tax resident and a tax non-resident. We are a tax residency-based system in South Africa, which I always say is great. It's better than being a citizenship-based system. It's not as great as it used to be when we were a source-based tax system before 2001. But a citizenship-based system would have been one and that's where people get confused, where you would have been, if you're a citizen, that's tied to your taxes. Okay, so people assume, I've given up my South African citizenship. I no longer have to speak to SARS. That's not the case. Okay, so be very careful of that. A tax residency has more to do with our legislation and tax residency tests. They're not to do with your citizenship or anything like that. Now, a tax resident in South Africa, you are legally required to declare your worldwide income, so foreign, local, from third country, anywhere. Declare all of that to SARS. And then you apply, be it exemptions or tax credits, rebates, whatever it is. A tax non-resident is only then liable for South African sourced income. Okay, and a lot of people think that just because they've left or they work abroad, they are the second category, the non-resident. Unfortunately, you've got to prove your case. And then there's two different ways, which is exactly what you were mentioning, the annual way to cease tax residency or the once off. And then there's that third option, which is claiming the foreign income exemption, which covers you if you're an employee up to R1,250,000 of your foreign employment income. Of course, each of these routes have the criteria you have to meet, but they're all very good routes to help you and protect you from double taxation.
Okay. Hi, Jasper Basson here. I just wanted to remind you about the Daily Entrepreneur Tips series. It's a business growth series for entrepreneurs and contains financial information and also information to grow you as a person and your business, because we will never grow our business any higher than we grow ourselves. So click on the link below and I will send you daily information to grow you as a person and your business, and it's for 365 days of the year.
Well, I think that's a nice and broad answer. Now, let's say I'm in South Africa, I want to immigrate to America, and I go through the whole financial immigration process, and we can go through all the nitty-gritties of CGT and all those exit tax and everything in a moment. But let's say I want to move out, but then in a year or two's time, I decide I don't like USA, I rather come back to South Africa. What would be the strategy moving myself back? Would it merely just be letting SARS know I don't want to financial immigrate anymore? I'm back in the system, or what do you do?
So firstly, on the good news side, absolutely, you can come back. We're a tax residency-based system again, which means you can reinstate your tax residency, okay? If you've seized it, be it once off financially immigrating or the double taxation annual agreement way. It's all case dependent again. So that's why I say always get the right advice. Because the way you seize your tax residency, especially the financial immigration once off way, is dependent on your permanent intent. Okay, so are you intending to reside abroad permanently? And again, it's the word intent, because we can't guarantee life. We don't know what's going to happen. It could be a visa issue, could be a health issue, could be a million different things that would make you, move countries. Now, say you do move, doesn't work out, you come back, there are ways absolutely to reinstate yourself as a tax resident and still protect yourself backwards, okay? Again, it depends on the situation, but most likely it would be unforeseen circumstances that your permanent intent changed and you're no longer going to be staying in the States. You're now going to come back and live in South Africa on a permanent basis again.
Okay. Right, so then I've touched them quickly, but financial immigration, now I know there's this exit tax, potential capital gains tax. How would that work in a situation with financial immigration?
All right, so the exit tax, as we call it, is actually something that's seen as a very greedy part by SARS, but it's actually not when you break it down as to the reasoning why it exists. So the exit tax is a capital gains tax as a deemed disposal. Basically, when you own capital assets, they look at it as if so they'll look at your worldwide assets, by the way, at that point for the exit tax, so not just South African. And capital assets, it's not personal use assets, not vehicles, not clothes, things like that. It will be more properties, trusts, vested trusts, shares, any businesses, things like that, like an actual capital asset. And they look at the value it has at that point from when you acquired it versus then. And they say you're deemed to have disposed that asset, so sold it and reacquired it again on the same day. That way they can tax your capital gains until that point. Now, the reason for this is because when you become tax non-resident, be it the annual DTA way or the financial immigration way, you are no longer due then to pay capital gains tax in South Africa on anything, be it South African or foreign, except for South African property or property-rich companies. Okay, which is then why properties are excluded, South African properties are excluded from this exit tax. So this could be your biggest hurdle when considering seizing your tax residency. So that's where a bit of tax planning needs to come into play. So always speak to an advisor and plan your timing, plan your assets, see what you hold, how you hold it, what has it grown in value, would it qualify for the exit tax? But yes, it can be quite the hit for some people, or some people don't even have, some people are very liquid. So it's definitely something to get a consultation on.
To you, give a comment if there's anything that you want to add to this video. I would really appreciate that as well. And obviously if you like my channel and follow us. Enjoy your day and I'll speak to you soon. Bye-bye.